Welcome everyone to our Sunday evening live Q&A, and this is the last one of 2021. And welcome everyone. I can see we've got some comments already. That's great. So welcome, whether you're supporters or whether you're not. We usually have an hour together. I try and answer questions about investment, and Teddy has some snacks. So this will be a especially festive one. So there'll be extra snacks today, and there'll be lashings of fizzy pop. There we go. Right, one more treat, Ted, one more treat. So don't forget to like our stream and also to share with other people, because, you know, obviously that helps us if you just like the stream. Very easy for you, just click on the like, and of course you can subscribe to our channel. Let's start asking some questions. And I see we've already got one of the questions from one of our supporters. No more now, Ted. I'll have to do some talking. Yeah, so we've already got some questions from one of our supporters. He's also a Patreon supporter as well as a YouTube supporter. If you are a YouTube supporter, and you can become one during the call, incidentally, it's very cheap to do that, because, you know, we wanted to make it easy for people to support us, so you can do that very easily. And if you are a supporter, then you'll be pushed to the front of the queue with the questions, or you can do a super chat. Both of those will get pushed to the front of the queue. So first question at the front of the queue is from Hisham Daoudi, who says, I joined PensionCraft Patreon today. That's nice to know. Let's hope I can earn back my subscription fees with your solid teachings. Let's hope so. And if not, I still like your videos and analysis. That's really kind of you, Hisham. Thank you very much. And Hisham says, I'm still drip feeding over the course of the next 18 months to be fully invested in equity. Would it be a good idea to get 5% yield with Euro stablecoin with the cash that's temporarily available? Yeah, I mean, if you do want to do yield farming, if you do go for one of the stable coins, just make sure it's one of the platforms which is fairly well known. Obviously, there are some issues with, if you are kind of mining on a platform, so platforms like Nexo, for example, hold your coin on your behalf, so you don't really own it. So there's always a risk they'll be hacked, and you could lose a substantial amount of money if you do that. So, you know, I'd really still be careful about security. You know, obviously be careful with the passwords, but also with the choice of the stable coin that you go for, they have to be transparent. They have to tell you what they own. A stable coin is very much like a money market fund, which isn't transparent. With a money market fund, you put in $1 or €1 and you expect to be able to take out €1. That's the idea. They mustn't break the euro. And in order to do that, they have to invest in ultra safe investments. So basically they'll invest, hopefully, in similar things to a money market fund, which is short duration government debt, and very safe credit instruments. So these would be commercial paper, which is a loan to a company for a period of less than, say, 180 days. And usually it'll be top credit quality companies to whom the loans are made. So just make sure that you know what is behind the stablecoin. Just make sure it's one that's okay. So, for example, when people looked at what was in Tether, firstly, what was worrying about it was they weren't very forthcoming with their investments. And when they were forthcoming, it was pretty clear that some of the stuff they'd invested in was very far away from the safety of a money market fund. So, you know, just be super cautious about what's in the stablecoin fund. But yeah, I mean, if you can earn 5% yield with a stablecoin and it's in your domestic currency, then, you know, it's got low volatility because it's linked to your local currency, and it's giving you a fairly good yield of 5%. Yeah, so you could do that. Just be cautious about putting too much onto the platform and about security, and I think you'll be okay. I mean, I'm doing it with Nexo and BlockFi. Those are the two I'm using. And I've gone down the stablecoin route. So, you know, I've also got, unfortunately, with the stablecoin in BlockFi, it has to be US dollar based. So from my point of view as a sterling investor, I'm taking the currency risk. So the vol is actually quite high relatively, compared to having it in sterling stablecoin, which is what I've got on Nexo. So, just be cautious, I'd say. Do your due diligence. I'm sure you would. I'm sure you'll be fine. Okay. And that wasn't a recommendation, clearly. Okay. So, next question is from... I can choose anyone I want. Great. So, Sophie says she just invested half her money in equity and I won't invest the rest of it for at least 1 or 2 years. Would it be more sensible to keep it in cash, or would it be a better idea to invest it in Treasury bills? Well, T-bills are US government debt with 1 year or less until maturity. That's very short duration. So it's actually very cash-like, both in terms of returns and volatility. You'll probably get slightly more with the T-bills, I'm guessing, in terms of return, but it'll be negligible. In terms of real return, it'll be negative because inflation's currently above 5%, right? So above 6% in the US. So, just bear in mind that, there's not much to discriminate between them. So, cash, I guess, is going to be safer. With T-bills, there'll be a little bit of volatility because if interest rates increase, if the Fed hikes, when the Fed hikes this year, next year, 2022, they say they're going to do 3 hikes. The duration of the fund will be about, 0.75? And if rates go up by 0.75%, you'll get 3/4 of 3/4, which is 9/16, which is about 0.5% fall in the price of that fund. Okay? So just be aware of the duration effect, and you won't lose no money, but you will lose very little money with one of those short duration funds, even if interest rates increase by how much the Fed said they will. Yeah, so I wouldn't, there isn't too much to discriminate between those two choices. Safety would be greatest in cash. With T-bills, you'll get a little bit more return, but you'll have a bit more volatility, but still not much. But on the other hand, the T-bills will rally slightly if equity markets fall sharply. So, but T-bills don't rally that much anyway. So, for example, last year in the 40% sell-off in equity, short-term treasuries, I think, so for example, the SHY fund, which is 1 to 3 year, that gained by about 4%, something like that. So a 1 year fund would gain by less, maybe a couple of percent tops. So it does rally more than cash, but importantly, it doesn't lose value if equities crash. That's the important thing. So really, it's up to you, Sophie. That's the trade-off. Next question is from Agatha. That's nice. We've got 2 women on the call. Yes! Brilliant. Is the end of 2021 and the beginning of 2022 the time to buy, sell, or wait and see what happens in 2022 before making a decision? Yeah, this is a question I get all the time. So invest now or wait. In fact, I made a whole video about it. Now, there's quite a bit of research which shows that it's best to invest straight away. So don't wait for stuff to happen. Don't wait for markets to get cheaper, because you could be waiting a long time and you'll miss out on the returns. So it's more important to have time in the market than to do timing the market, right? Because usually we get that wrong. And there's always a reason to be scared, and usually the reasons are wrong, okay? Even if you're a strategist at an investment bank, I know that, you'll be wrong a lot of the time. So it's best just to be humble about it and admit you don't know. And what you do know is that the long-term return of equity is high. In an average year, equity goes up by 6%. The probability of a crash in a given year is very low. So, I think it's fairly safe to lump sum invest. Just be ready for when a market crash does happen and don't sell. As long as you've got that in your mind, then that's fine. Now what I'm doing is drip feeding. So I've got a 2-year drip period. I've done 7 months of it. I've got just under 1.5 years to go. And I'll just accelerate it if equity markets do correct sharply. But that's my choice, right? And I'm very cautious, and that might not be appropriate for you. And obviously I've missed out on returns while markets have been going up. Towards the end of 2021, it's been a bit wobbly, but generally the returns in 2021 have been very good. So if we do have a look at that, it's interesting if you look at the returns by country. So let me just share my screen. There we go. And so let's have a look at, so this is sorted by 1-year return, right? So highest return at the top, and each of these is a one country exchange traded fund. So top of all of them is the UAE, United Arab Emirates. Saudi Arabia is second. Both of those have had 1-year returns of 31 and 34%, right? Then we get to Austria, Taiwan, the S&P, of course, the US, and then Vietnam. So all of those have done incredibly well. In fact, we have to go all the way down to probably South Africa, Belgium, Poland, Italy, where returns are below 10%. And then we get into negative territory. And a lot of these are by choice. So, for example, China chose politically to favour politics over their stock market, and they're down by 20%, according to the Spider S&P China Fund. So a lot of those countries have made a choice not to do well this year. You know, you have to try pretty hard to lose money in this kind of environment with huge risk appetite. Turkey is another country where, you know, we've seen what's happened to the currency there because of the central bank, because the president's decided that if he wants inflation to be lower, he actually wants to lower interest rates, which is a fairly unconventional approach, which doesn't convince markets. And even though he's kind of stabilized the currency with a kind of deposit guarantee scheme, which was launched on Monday, we still haven't seen the equity markets recover much. So that has been a bit of a train wreck. It has been very volatile and generally down rather than up. Has been a bit of a rally, a huge rally today actually. So that's up from 19 to 21. So not a huge rally actually. So from that bottom, 24% over the space of 4 days. But then if we compare that to, just a month ago, it's down about 9%. So very volatile as markets digest this new information. But a lot of these countries have decided effectively to sabotage their own markets. So, but this just goes to show, right, if we go over a long period of time, so let's look for GSPC, which is the S&P 500. Over a long period of time, you can effectively ignore the bumps, and I'll put it on a log scale so that we can actually see the returns going back to 1962. You get these massive crashes, which at the time feel like the end of the world, but really, if you'd have just stuck with it and kept on investing, you'd have been fine. And most of the time, everything is fine. So if you just put money in, forget about it, get on with your life, have a fun life, be nice to people, you'll come up with a fairly good result at the end of it if you go for a global index. There are particular markets where there hasn't been such a good return. Sometimes you get 100% loss, but it's very unusual. And if you buy a whole global equity fund, which you can nowadays, then it's globally diversified, and that's very, very, very unlikely to happen. So, just diversifying, keeping it simple, for most people is probably the best thing to do. So let's go back to your questions, and let's just see if we've got another question. Yes, we do. So another supporter question from Stephen J. Thank you for supporting us on YouTube, Stephen. Remember, you can also support us. It's very easy. Just click on the join button, and that way you can very easily sign up, and we'll push your question to the front of the queue or do a super chat. Stephen says, why is bond duration different from bond maturity? is a rule of thumb, as you said, 3/4 or 7.5% duration, up and down for 1% Fed funds rate for a 10-year maturity. Okay, so generally, I've just worked in fixed income for so long that I kind of got used to roughly what the duration would be for a bond of a given maturity. So roughly for a 10-year Treasury, the maturity will usually be about 7 years. It's usually a little bit less than the maturity of the bond. A 3/4 rule is roughly right. So a 20-year Treasury would be about, 14, 13, 12 years. But even for a crazily long maturity bond, it only gets to about 20 years, even if it was like a perpetual bond. And that's because the actual duration of a bond is the present value weighted average time of its future cash flows. So if they have zero coupon, if they don't pay any coupons at all, then there's only one cash flow at maturity. And in that case, the duration is equal to the maturity. So a 10-year zero coupon bond would have a duration of 10 years. But with a coupon bond, because you're getting all those little cash flows beforehand, the actual time weighted cash flow is before average time of the cash flow would be before the 10 years is up. So it really depends on the coupon as well. So if the coupons are very small, it approaches a zero coupon bond, and that extends the duration of the bond. So currently, with yields so low, the duration of bonds has gradually increased, which is kind of interesting. But as yields creep back upwards, as they have been since summer of this year, then you'd expect that the duration would shorten slightly for your average bond. But the 3/4 rule is roughly right. And remember, duration is only a kind of back of the envelope approximation for sensitivity to interest rate movements. It's not an accurate thing. So I wouldn't, take it to the 10th decimal place. I mean, that would be crazy. Duration is just so you can do calculations in your head. If yields go up 1%, the price of your fund will go down by duration times 1% times -1, right? So if the duration is 7 years, interest rates increase by 1%, you'll lose 7%. Interest rates increase 2%, you lose 14%. So it's just duration times change in yield gives you the percentage change in the fund or the bond. So it's a really useful stuff to be able to do in your head, because I think a lot of the panic about markets and bond markets in particular is because people don't really think about duration. If you think about where yields are going to go, and if you think yields are going to go up a lot, just shorten the duration of your bonds, of your bond fund. It's really that simple. So anyway, that I hope answers your question, Stephen. Next question. Good question that was. Here we go. Good one from Timothy, who says, "Hi Ramin, can an ETF provider change the expense ratio they charge us on their own accord at some point after we've bought it? Thanks." Yeah, they do this all the time. It actually helps to understand how they charge you. So for example, let's say that you've got an exchange traded fund which charges you 1% fee. Okay. So the way that works is, they'll buy some stuff, it generates some returns, but then every day, every trading day, they'll subtract 1/252th of 1% from the return of the fund. So it's almost invisible to you. They might try and make it up by jiggling the contents of the fund, but that's going to be a drag on return due to the fee. But it's a tiny drag, and it's charged daily, and it's not coming out of your pocket, it's coming out of your returns. And that's why, for an ETF, if they drop the fee, all that happens is that minuscule subtraction of return will just be slightly more minuscule. So literally they can do it overnight and you'd never even know. It's really that simple. So that's why I think obviously a lot of funds have been cutting their expense ratios. Vanguard's done it. Fidelity's done it. If you follow Eric Balchunas on Twitter, the ETF guy from Bloomberg, he's always quoting, he calls it the Terradome, because, you know, it's terrifying being a fund manager in this environment because, you know, it's real cutthroat competition between fund managers to get flows into their fund. And for an S&P tracker, they're almost charging nothing now, right? It's almost got to the point where the fund management fee is zero for the big trackers. So, you know, I mean, I don't pity them because, you know, they're still making a good living. But I think, you know, cutting the fee is not a problem for them. It's a problem from their revenue point of view, but hopefully it'll attract more capital. So when the assets under management goes up, hopefully it'll compensate for the reduction in the fee. I think that's the logic behind it anyway. Okay, so do remember to like our stream. That helps us a lot. And I think it's time for another snack. So I promised there'd be lashings of snacks for Teddy. You come on. You go and have another snack. Good boy. Yes. Good boy. There we go. Right. So Teddy's done his job. Back to my job. Back under the desk. That's it. There you go. That's it. Right. I'll give him another snack under the desk. You'll just hear the crunching. There we go. And fizzy pop for me. Right. Next question is from, well, let's just see if we've got one more question from a supporter, because remember they get pushed to the front of the queue because we have to eat. So we do prioritise people who support us, and Gary supported us for ages, so thank you, Gary. Each one of our YouTube supporters. Have you looked at the new Vanguard funds? Sustainable Life 80 to 90% equity fund. Not so cheap. Interesting. I haven't seen that. Is it an active fund? I wonder. Let's just have a quick look at that. Sustainable Life Vanguard. So they're getting on the ESG bandwagon. And here we go. So let me show. Oh gosh, 0.48%. That is expensive. Let me just show a screen. Right, so 0.48% for this fund. And if we look at the way it's managed, yeah, so this is an active fund and it's managed by Wellington, and that's a fairly well respected active manager. And yeah, well, that's why it's expensive, because it's actively managed. I mean, is that expensive for an active fund? Probably not. But, you know, I've got issues with sustainability, and ESG as a kind of method of investing. But yeah, I mean, it was inevitable they were going to come up with some kind of life strategy equivalent, but make it ESG. But they haven't gone for a passive one. Perhaps they didn't have enough passive funds to construct a passive version of life strategy which was ESG compliant. Interesting though, I hadn't come across that. Thank you for sharing that. But I think that's why it's expensive, because it's the fee for Wellington. Here we go. Nope, we're back. Right. Was there any other part of your question I didn't answer? No, you were just commenting that it's expensive, and it is. Next question is from Kevin, who says, could you please discuss details on investing in a floating rate bond ETF? Risks, are they immune to rate lift-offs and inflation? When is it best to invest in them? And how to choose the right ETF on floaters? Good question. So with a floater, so normally what you get with a bond is you fix in a rate of income, rate of interest for the entire life of the bond. So when it's issued, it comes with a built-in coupon. So let's say the US Treasury issues a 10-year bond today. Let's say the coupon is 1%, right? So for every year for the next 10 years, you'll get 1% of the amount you invested. So $1 for 10 years. and then on the 10th year you get another dollar and you get your $100 back, right? So that's the way it works for a fixed rate bond, and that's fixed income. For a floater, it's very different, because what happens is the coupon resets based on some reference rate, and the reference rate will be something like, well, it used to be LIBOR, the London Interbank Offered Rate. It'll now probably be SOFR or one of the market observed rates. But it's the same idea, which is that it's the current rate of interest for a high credit quality company, AAA, right? So if it's a government bond that's issued it, there'll be no spread for the credit. If it's a corporate floater, it'll be the risk-free floating rate plus some spread for the credit risk. Now, what's special about that, you might be thinking? Why is that different? I mean, if I'm just resetting the rates based on the current rate, what difference does that make? Well, it makes a big difference, because the actual duration of that fund is only as long as the reset frequency. So let's say you reset the rate every year. Well, in that case, you freeze the coupon at the beginning of the year based on the observed rate that you're looking at. Then it's fixed for a year, and then it'll set again based on the new rate. So the duration of the fund is actually just 1 year. It's the reset frequency. So usually the reset frequency on floaters is quarterly, and that means the duration is a quarter of a year. And that means it's really insensitive to interest rates. It's slightly sensitive, but not very. So what drives the value of one of these floaters? Well, one thing which does affect it is the credit risk. So a corporate bond floater is driven purely by the credit spread. So when a company's looking more shaky, more likely to default, it decreases the probability you'll be paid out back your $100. So that reduces the value of the bond. So what happens with floaters is, instead of jiggling about in terms of price as the yield curve flops about, they don't see that, they don't feel it. So they have a very smooth price. But what you see is very slow movements up and down according to their credit spread. If their credit spread widens, their price falls, because you're less likely to get your money back. If their credit spread tightens, if their credit quality improves, then their bond price increases. It's always still worth around 100, just like any bond, particularly as it approaches its maturity date, but its duration is almost zero. So very little interest rate sensitivity. It's still got credit sensitivity if it's a corporate issuer. If it's a government bond, obviously we'd only have credit risk if it's issued by a dodgy country. The US would have almost zero credit risk, but an emerging market floater clearly would have some credit risk. So that's the way a floater works. In terms of interest rate sensitivity, almost nothing. In terms of inflation sensitivity, you could say that the rate that it fixes in actually incorporates inflation. So it doesn't really care about inflation either. If inflation goes up, then it should increase the coupon to compensate. So in that sense, it'll only depend on, so the inflation sensitivity would be change in inflation times duration. So it'll be fairly limited, the inflation sensitivity as well, right? So I hope that answered your question, Kevin. I think it did. But is it sensitive to lift-off? Not really. It would be slightly sensitive because it does have some duration, but very little. So it'd be like it would just be almost identical to a Treasury with a maturity of a quarter of a year to the reset frequency of a coupon. Yeah, there we go. Next question. Oh my goodness, it's past. Next question. Let's just see if we've got any other questions here. Yes, we do. Another question from Gary, who's one of our supporters. Thank you, Gary. Remember, you can do a super chat. We'll push you to the front of the queue and answer your question. And do please like our stream and subscribe to our channel. I've been told to say that, and I have now. Gary says, ESG gets you out of China, which is in emerging markets. So ESG now, if I was an EM before. Right. Yeah. Yeah, I mean, I don't think China's going to score very well on ESG. I think you're right. But I mean, you could always go for an ex-China fund. If it is China that you're trying to avoid, then you could always do that. Interesting to see if that actual fund has got any exposure to China. It doesn't actually tell you what's in it. It's not very helpful. Oh well. Okay. But I think you're right. I think it probably wouldn't have much China in it. But if that was your justification for going ESG, it would be much simpler, I think, just to avoid China. And I've noticed now they've started issuing ex-China funds. So you can buy EM, for example, ex-China, which previously would not be very popular. But I think now it probably would be, right? Not only because of the ethical concerns, but also because the returns haven't been very good. Right, so back to your questions. For non-supporters, or current non-supporters, I'm always hopeful that some of you will support us in future. Siramis, hello, nice to see you again. Good evening, Ramin. Good evening, Siramis. Here we go. So question from JW Townhill, who says, hi Ramin, what do you think of risk parity funds compared to standard 60-40, e.g. AQR risk parity or MAN AHL target risk? Are they worth investing in for individuals? Yeah, so if you're not aware of it, let me just briefly say what risk parity is. So the idea is that the approach to allocation, asset allocation, is you say, well, what I'll do is I'll buy this much equity and this much bonds such that both of them contribute an equal amount of risk, if risk is measured by volatility, to my portfolio. So if you wiggle either one, it contributes the same amount to the volatility of your portfolio. Now, if you didn't lever up the fixed income side of it, because bonds are usually much lower volatility than equity, you'd buy a disproportionately large amount of bonds and your fund would just have lousy performance, because long term, bonds usually return about 4% less than equity, historically, maybe even 5% less. So why doesn't that destroy your returns for your portfolio? Well, what they do is they say, what we'll do, instead of having less equity, we'll actually lever up the bonds. So instead of buying, so if you give them $1 to invest in bonds, they'll borrow another $1, say, and double lever the bond side, or lever it by a certain factor such that the volatility of the bond side is equal to the volatility of the equity side, right? So that's called risk parity. It just means equal risk from each of the different allocations in your portfolio. You could have a risk parity fund that has gold, treasuries and equity, and each of them would have roughly the same contribution to the risk of your portfolio. So that's the way it works. Now, the kind of environment where it goes wrong, badly wrong, is when interest rates are increasing and there's a taper tantrum. So, for example, in 2013, there was a taper tantrum. And if you look at AQR's risk parity fund, it did really badly because it got hit on the bonds, which fell when the Fed said it was raising rates. It got hit on the equity because it had equity as well. And it had a levered position in the bonds. So instead of falling 6%, which is what you'd have got if you were a 60-40 equity investor, it fell 12% because it got hit on both sides, and it got hit even harder on the bonds because they were levered up. So, if you're expecting another taper tantrum, and maybe we won't. It's been very well signaled by the Fed that we're going to have 3 interest rate increases this year in 2022, next year I should say, in 2022. So we know it's coming, but people still panic. It just happens that way. People see the rates increase, and although you've been prepared for it, it's kind of like an injection, right? Very topical. It's coming, and you can prepare yourself mentally for it, but it still hurts, right, when it happens. So I think that there may be a little bit of a jitter, and AQR and risk parity funds would suffer as a result. Is it worth buying? Well, it depends on the fee that you're paying. So I don't know how much AQR's fund is charging. I don't know if I can quickly look it up. Probably not. So let's have a look at these risk parity funds. Global risk parity, here we go. So let's have a look at the financials, and I'll share my screen so I'm not just talking. There we go. And I'll appear in the bottom left. Right, so here's a global risk parity fund. This one's in Swiss francs. I won't get that one. I'll go for the primary share class. So this one is in sterling. It's an accumulation fund. The fee initially, I mean, that's the first thing I'd look at, is 0.5%. So that's pretty steep. You know, I wouldn't pay more than about 0.3% probably for a fund. So maybe. But then if you look at the actual returns, and if we add something like the S&P, just for comparison, you can see that, you know, the return of the S&P is in blue, the return of the risk parity fund is in black. I mean, the selling point of risk parity is that the volatility is lower than, say, a 60-40 with the same return. But in this case, look, you know, 100% equity fund, which is simpler and which has a fee of about 0.05%, has outperformed it very substantially. So, you know, you can buy them if you buy into that kind of risk parity narrative. But personally, I don't really think it's worth it. But look, I've done a whole course about asset allocation. Risk parity is one of the things I discuss, and it's called the Asset Allocation course. So I used to be a strategist at an investment bank, and I kind of captured the essence of what I learned in my stint as an asset allocation strategist and put it into this course. I kind of put my heart and soul into it. Anyway, you can buy that on our website, PensionCraft.com, if you want to learn more about that. But I talk about off-the-shelf investment strategies, and risk parity is one of the ones I discuss. But it's certainly one approach, you know. But you can always build your own risk parity fund. It's not that difficult to do. It's the leverage aspect of it which is tricky if you're not a kind of institutional investor. But certainly to build a normal risk parity fund where you have equal contributions to risk is very easy. The problem is that you just end up having huge amounts of fixed income in it, because that tends to have low vol. But as an approach, yeah, just be aware of its limitations. And, you know, the returns haven't been that spectacular, I have to say. Right, let's have a quick look at the questions. We've got 22 minutes to go. And let's go and answer a few more. Don't forget to like, subscribe to our channel. Then that way you won't miss all our good stuff. And we have another question. Oh, no, I shouldn't have done that. Got a question from... Oh, Andrew Lester says, good evening all. Last one before Christmas. All the best to Ramin, Laura and Teddy. There we go. Teddy, I mentioned you. That means you get a treat. Come on. Up, up, up. You stand up. That's it. Good lad. You're getting sick of the treats. You sick of them? Anyway, you look at the screen. You see? There are people in the camera. No, it's there. Could be squirrels. No, that's a false alarm. There we go. Good boy. Brilliant. So, we actually have a question. Oh, Such Media said, hi, Ramin. Oh, no. Somebody said it's not Sunday. That's true. Philip Schmidt, interesting question, who says, why should you buy a swap ETF rather than a physical? So, just to explain what that means. So let's say you buy an ETF, right? So let's say it's an S&P tracker, okay? Let's say you're a UK-based person buying a S&P tracker via an ETF. Now, really, you never see what's inside the ETF. All you see is that its returns are roughly equal to those of the S&P. That's all you want. But there are various choices which the fund manager has as to how they can match the S&P. So either they just buy the stocks in the S&P, but the trouble is there are 500 of them, and some of them are very small, and it's not really worth buying all of them. You can still match the returns of the S&P very accurately without buying all of the stocks in the S&P. So, for example, the Nasdaq this year, you could have just bought 11 stocks and matched the returns pretty closely, just the top 11. But generally, you don't have to buy all of them, and that's called a physically sampled ETF, where you just buy a subset of the stocks. And there is some judgment there according to which ones you buy, but usually it's the biggest ones. That way it tracks the index closely. Or plan B, so let's say our clients give us $1 billion or £1 billion. If we wanted to track the S&P, another way of doing it is saying to our investment bank friends, hey, we'll enter into a swap with you where you pay us the returns of the S&P and we'll pay you a fee, right? So that's the way it works. Now, you don't have to give them the full amount, the entire 1 billion that you've got from your clients. So with the extra cash, you can actually increase the returns by investing in something safe like treasuries. So those generate a small extra return on your capital, which you can choose to give back to your clients or not. And at the same time, you can match the returns of the S&P because your investment banking friend is paying you those returns. So if the S&P goes up, they pay you. If the S&P goes down, you pay them. So usually these things are collateralized, so it's very safe. That way you never end up owing the bank too much. They don't end up owing you too much. And you'd have ISDAs in place, so you kind of net off all of your swaps with them, with a particular bank. Or if you're BlackRock, you can actually have 3 banks that you do the swap with in case one of them goes down. BlackRock can do pretty much whatever it wants because it's so big. So that's the way it works. It's synthetic because you don't pay the full amount to the counterparty, to the bank. You can do some return layering behind the scenes, so it could generate extra income for you as a fund manager. So that's the way it works. Now, the beauty of this is that because the bank is the person who actually holds the stocks that generate the income, investment banks generally sit on all the exchanges around the world, and they don't have to pay any withholding tax on the dividends for the stocks as a result of that. So if they sit in the US, they'll be the beneficial owner of the stocks which your fund is exposed to because it sits on their balance sheet. Effectively, they're the owner. There's just an agreement to pay you the returns, right? So that's why they can pass on that benefit to the fund manager, no withholding tax, and the fund manager can pass it on to you. Now, if you're not paying a withholding tax, that can make a big difference to your total return. So if you're paying a withholding tax of, say, 15% over 40 years, that can really compound. So I think that's why people are kind of coming around to the idea of synthetic ETFs, because there's no withholding tax, at least not at the moment, and so that's very attractive. People used to say, I don't like it because there's counterparty risk with the investment bank. We still remember 2008 when it looked like banks were going down, some of them. But now, people aren't so worried about counterparty risk with banks, but they really care about getting all of the dividend because it means more return for you. So, I think swaps, I'd have no issues at all with a synthetic swap. In fact, I'd, actively choose one over a non-synthetic one, simply because of that, efficiency. Right, next question. See how we're doing. No more questions from supporters. If you do want to have your question pushed to the front of the queue, don't forget you can do a super chat or support us, and don't forget to like and subscribe. Talbot Sunbeamer's here. Brilliant. Evening, Ramin and Laura. Merry Christmas to you both. He supported us for ages. Thank you, Talbot Sunbeamer. Very funny guy. Right. Funny in a nice way. So there's a question from Harold Betterson. Hi, Ramin. Ramin. Interesting. What are your thoughts on PLTR Palantir? Thanks and Merry Christmas. Well, I don't really do single stocks ever. I mean, Palantir was one of those kind of meme stocks, wasn't it? Let's have a look. I'm not sure I'd have much to say about a single stock. Let's have a look at the returns, though. For a laugh. Let's make fun of a macro strategist talking about a single stock. So here are the returns of Palantir. So that's in black versus the S&P 500, which is in blue. So huge outperformance in 2020. So this was a Cathy Woods type growth stock. And it had a return ticket to outperformance. And now it's pretty much back in line. Not completely, but it's still outperforming the S&P since it's existed. If we have a look at the financials. So clearly a growth stock because it's generating a loss. The EBIT's negative, the operating profit's negative. It's probably forecast to grow a lot. I mean, that would be the attraction, right? It's a growth stock. So, yeah, there's a bit of gearing there. Yeah, I mean, as I say, I never buy a single stock. Very unusual for me to do that. But, you know, I just look at the normal things like return on capital employed. If it's a growth stock, I'd look at price to sales. I'd look at the market that it's in. You know, what are the competitors? What's its USP, if there is one? Does it have some kind of competitive advantage, which would stop competitors stealing its lunch? You know, all the usual stuff. But, I mean, I don't really have expertise with Palantir, so I couldn't really comment on that. But, you know, would I buy an unprofitable stock going into a rate hiking cycle? Probably not, you know, however good the story is behind it. But generally, I don't buy single stocks anyway, you know. Next question is from Alan Jones, who says, 2022 view on HSBC Global Strategy Funds, Adventure seems weighted on S&P. Yeah, so if you're not aware, life strategy funds, everybody's heard of them from Vanguard, risk graded, so 20% equity, 80% bonds, 40% equity, 60% bonds, all the way up to 100% equity, 0% bonds. So 5 funds, risk graded, up to 100% equity, down to 20%. So very simple, globally diversified, but they have a huge UK bias. They've got a roughly 6-fold weighting overweight for the UK, allegedly because it's easy to market the funds. So I don't like that at all, because I don't think that the UK will outperform necessarily in future. So for the sake of marketing, I wouldn't go for life strategy. HSBC's strategy funds, on the other hand, are roughly market cap weighted. They're either the same price, the same fee, or slightly cheaper than life strategy, which I love. And they are global market cap weighted. Now that does mean they have a big US weighting, but that's just market cap. Market cap is high for the US because it's had a very successful stock market and probably will continue to have a very successful stock market. So, you know, I've got no issues with that at all. And I love those funds, actually, the HSBC ones, not a recommendation. But I do like them because they're cheap, global market cap weighted, diversified. So it's all the things that Vanguard Life Strategy is, but without the UK overweight. I can't hold them on my Vanguard platform because I can only hold Vanguard funds. But, you know, I think they're great. Yeah, I think they're good. Would I worry about the heavy weighting for the S&P? Probably not. You know, I think that's okay. What you could always do is just split it up. So instead of buying a global equity fund or, you know, Life Strategy or HSBC Adventurous, which I think is that the 100% equity one. I think it is. Why not just buy a global equity tracker? They're very cheap, and then you can split it out. So you don't have to have 60% US. So you could buy developed ex-US maybe. So you could buy a European one, Japanese one, maybe a bit of emerging market, and then just dial down the US. So instead of having 60%, maybe you'd have 40. But underperform, you know, going underweight the US is a pretty ballsy decision in this kind of environment because... What's that? Full screen. Yes. Sorry. Laura just shouted down from upstairs. Go full screen. Right. So, you know, would I go for one of those HSBC ones? Yes. I think they're great. Fees low, no UK overweight, and the US overweight I think is okay. But you can always split it up. Instead of buying a global one, just buy regional equity funds, and that way you could, you know, dial down on the US. But personally, I wouldn't, right? Because I think the US will continue to outperform for some time to come. Next question is from Tom Lee. Oh no, it's about Tom Lee. Have you heard of Tom Lee of Fundstrat? No. He's on CNBC and has a theory about market booms being based on demographics and predicts a strong bull run until 2029 because of the 30 to 48 age cohort. Yeah. I remember, you know, every now and then you get these papers that come up and they talk about demographics and market returns. I mean, there was a standard theory that was knocking around 5 years ago, something like that, 10 years ago, which said that because there are so many boomers around, you know, they were effectively, when they retired, they were going to move into fixed income, and that would generate a big shift away from equity into fixed income. And as people age, they move more into fixed income, so that's going to be good for, it's going to push down yields, and it's going to be bad for the equity market. Well, you know, none of that happened. So I think a lot of these demographic arguments make certain assumptions about the risk appetite of people as they get older. And I know for a fact, I speak to a lot of retail investors, I know for a fact that a lot of the older investors are not cautious investors, and justifiably so, because say for example you have a large amount of capital, you've got enough to live off, maybe you have buy-to-let property, maybe you have a defined benefit pension. All of that may give you enough to live off, and then any of the capital which you invest, you can take as much risk as you want because it's not money you need. As long as you don't take suicidal risk, right? If you go for 100% equity, you know, that's not particularly risky if you know that's money that's going to be in your family for the next 50 years. So people like that can actually take an investment horizon approach which extends past their lifetime. So they can be actually taking a hell of a lot of risk. So it's not the case that older people take less risk, I don't think. I think that's completely flawed thinking. And in many cases, it doesn't make sense for them to take low risk because they run their portfolio like an endowment, right? Because they effectively have a generational investment, which, you know, pass on to their family, which they're just kind of guardians of for this generation. That's the case for many of the people I speak to, actually, in Power Hours. Oh, I think we've got a... yeah, we do. Okay, so that's really nice. We've got a... yeah, we've got a super chat. Thank you for that. Oh, it's Leonard. Leonard von Nebelschutz. Thank you, Leonard. That's really kind of you. Leonard says... Merry Christmas, Ramin and Laura and Teddy. Teddy, that's you, mate. You've helped me really getting deeper into investing in a bit more detail. That's my catchphrase. Have an enjoyable year's end. That's really kind of you. Thank you, Leonard. Yeah, I love talking to Leonard. He's a really interesting guy. It's funny because some clients you speak to and they've got some really interesting insights, which Leonard certainly does. There we go, Ted. So thank you, Teddy says.
Thank you.
That's Teddy's voice. Right. Brilliant. I think is there another question from... Yeah, so back to Apothe6's question. Have you heard of Tom Lee? I haven't heard of him. So I don't really buy into these kind of demographic arguments. I think what's pretty clear at the moment is that there are lots of people who are new to the market who have driven this retail boom, who have to learn the lessons that all of us have learnt if you've been in the market a long time, which is, the returns we've seen recently are unusual. And usually after a period of very high returns, there's a bit of a payback period. So the question is, how many of those people are going to stick with markets once the returns are kind of 6% per year, or even worse, right? I suspect not many. So really it depends on all kinds of things. I think that's why it's too simplistic to say this is the demographic distribution, this is how it's going to vary over the next 10 years, and this is the effect it'll have on asset returns. It's very difficult to make that link, and I'm not convinced that anyone can do it convincingly, because it makes assumptions about behavior as well as age, right? Next question is, how are we doing? We've got 3 minutes, so not much time for more questions, but we have a few minutes. Newtonify, good name. Big fan of Newton. Hello, thank you for your very informative videos. Thank you. If one wanted to moderately leverage your portfolio, how would you approach sizing it? Also, to avoid interest, are index futures a bad idea? Well, I think, leverage, the problem with leverage is contingent liabilities. So if you put £100 into a fund, you can only lose £100, right? That's the way it is. If you put £100 into a leverage investment, because of the margining, you could end up getting, a big margin call, if markets move against you. And that's very different psychologically to just outright owning a stock. Firstly, the maintenance required is much more demanding. Plus the stress of having to post margin isn't for everyone. You don't have control over that. Markets will move against you. You have to post the margin. If you don't post it, they'll close out your position. And that can be quite stressful. Whereas most people I speak to, they just want some investments which they can, create and leave and get on with their life. And with margin, you kind of can't do that. If you do want to get leverage, what you could do, for example, is buy. So let's say you wanted to get leveraged S&P exposure, right? So you could buy, I don't know. So if you have £100 to invest, you could buy £50 of it or £70 of it with an S&P tracker, which is very cheap. And the remaining £30, maybe you could get a 2 times levered S&P tracker. So that would give you your leverage. You don't have to monitor it. You don't have to post margin. It'll be a lot more volatile than just having an S&P tracker, but it'll give you your leverage. And by dialing up and down the amount which is leveraged, you could effectively dial up and down your leverage. So 100% S&P tracker, no leverage. 50-50, you can work it out, right? So that's probably a simple way to do it. Or you can use derivatives, but again, derivatives make it much more complex to maintain. So you can do it via, in the money call options with long maturities, long expiries. You can do that. But yeah, I think if you're kind of really set on having leverage, that's probably how I'd do it with the ETFs and the levered ETFs. That's probably the best way. Or if you're willing to put the time in, maybe use derivatives. You know, you can buy call options, or maybe via futures, but futures I'd probably avoid. You know, the margining is a pain. Anyway, I think we've reached our 8 o'clock limit. Yes, we have. Thank you for joining us. I'd like to wish you all a great holiday. Merry Christmas if you celebrate Christmas. And I hope you have a great period between now and the new year. We'll be starting again. Our next video will be posted on Sunday at 8 a.m, which is quite unusual. Usually we post on a Saturday, and we've got one ready to go. It's a cracker. It's a good one. So I hope you enjoy that, and just have a great and restful end to the year, and we'll see you in the new year. So have a great Christmas, everyone, and we'll see you soon.